not registered with the SEC or FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and or the team at Tradespoon or Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. So do please keep that in mind as you evaluate trades that we discuss or trades you're evaluating for your own personal investment and trading portfolio suitability. Good morning, everybody. I hope you're all staying warm. It's frigid here in the Midwest. That obviously is 2013, the winter of 2013, when wind chills in Chicago were like -40, -50. That was bad. But now, yeah, it's still cold though. Just not as cold as that craziness. Anyway, I think cash is still key because right now we're at the inflection point. I keep looking for trades that I want to put on for like the anti-bearish trade or for the breakout trade. And I'm constantly reminding myself from a psychological perspective that forcing a marginal trade is not a good decision. Cash is better than forcing a marginal trade with no expected value. I like being in the game. Otherwise, we wouldn't be here, right? I like being in the market. But I have to be selective so that I'm not utilizing my capital on marginal trades while waiting for a better trade. That doesn't mean I can't trade at all. There are decent trades out there that are worthy of capital. And if something shifts in the market where we get a breakout to new highs and I see better expected value elsewhere, well, I simply close the anti-bearish trade to free up capital to put into a more bullish trade. But when those anti-bearish trades aren't yielding enough return to justify the risk, I don't want to trade them. So if the probability of success for the anti-bearish trade still looks pretty high, but the return on capital looks particularly low, that's the problem I'm bumping into right now. Finding those trades that have key levels of support below the market that can give me enough return on capital to justify the trade. If I think it's got a 70% probability of success with a 30% return on capital and a 30% probability of failure with a 70% loss, that's a wash. That's not a positive trade. More what I'm seeing right now is return on capital in like the 20% range on those anti-bearish trades. And I don't like 15 to 20%. That eliminates my expected value, pushes it really close to zero. And in a tail risk scenario where something comes out, a la deep seek or tariffs that causes more major pullback, I want to have that ability to buy that dip with confidence and with capital rather than pitching out a losing trade with a reduction in capital, a psychological weight on me, trying to figure out how to manage that. I want to have a clear mind when the opportunity is there. So homework, important. I discussed that yesterday at the close. Yesterday was a big homework day for the market, I think, evaluating opportunities, looking for the setups that may be setting up today, maybe setting up tomorrow, maybe setting up next week, and being ready to capitalize on them then instead of trying to force something now that's just not a real positive expected value. So again, always trying to wait for that confirmation of the trend change. We attempted a breakout yesterday and did not confirm it. So we had the new high and then pulled back below the previous high. And today we're drifting back down. There's nothing confirmed on a potential breakout yet for the broad market. For individual stocks, again, yes, there are. Long and short the market at the same time with a certain bias is actually a very good strategy when there's the opportunity on both sides. So we do have that situation right now where, for smaller trades, maybe there are some bullish setups. Maybe there are some bearish setups. When we're sitting at an inflection point, if we get the pullback, I want to make sure that my bearish setups are going to offset the bullish. I was talking about this with a guy yesterday. Long, Palantir and short Southern Energy is not a spread trade. If the market comes down, the only way that those tend to both go down together, and I'm going to see a correlation, is if we get a major liquidation or a major push through in the market where we're buying everything. So I can look at those as a pseudo hedge to each other, but it's really I'm bearish on, in that case, utilities and bullish on AI, and they're not particularly correlated. If I'm long NVIDIA and short AMD, different story. Both semiconductors, I can have a neutrality bias towards semiconductors. They are still going to have correlation, even though it's not particularly high within the semiconductor world. It is still at least within the same sector, so I can get rid of some of that beta risk to semiconductors if I think that NVIDIA is going to outperform AMD, or if I'm going to go long silver and short gold. I'm trading performance relative to gold. Those are more of a real true pair trade. Uncorrelated assets aren't a pair trade. I mean, I could say short dollar and long market, but those are not a zero correlation or a positive correlation. Dollar going up doesn't necessarily dictate market going up. Dollar in the market can sometimes be a positive correlation, sometimes a zero correlation, and sometimes a negative correlation. So keep that in mind as you're evaluating how to structure your portfolio for the longs and the shorts. And frankly, for me, I look at this as an opportunity to say, I'm going to treat everything independently, even though I may have looked for some longs and some shorts. Unless I have an overweighted financials portfolio and I'm hedging with financials, I'm just long financials. If I'm long financials and short tech, I'm just long financials. And as a separate trade, I'm short tech. So again, I'm just thinking about that correlation element to my trades and not necessarily saying I'm somehow market neutral by being long financials and short tech. I'm not saying I'm short tech. I don't think that's a great trade. I do have one long financial right now still, like I mentioned before, Regions Financial, but looking to add more. Oh, and we're looking at Morgan Stanley, looking at JP Morgan. I think the financials have a good setup for the long side. I also don't want to overweight myself to a basket of 10 different financials and have no capital for other trades in case of market rotation. All right. And again, I don't like selling naked options. Now, if you are the type of person that is looking for an investment thesis of if prices go lower, I'm willing to buy, and I am actually willing to buy. But willing to buy as an investment, selling cash secured puts can be a good concept. But I always warn, if I'm selling puts in the S&P saying I would buy on a dip to 600, you know what always seems to happen in this psychological element? We dip to 600 and people start to freak out and worry, well, is 600 really below? Are we going to go to 595, 585? Do I really want to buy at 600? Oh my God, maybe I made a mistake. I'm going to pitch that trade and then bounce back. And it turns out it was a fantastic trade over a longer horizon. But over the short term, I can allow my psychological impact from taking a short-term loss cloud my view of the market and lead to a mistake. So selling the naked option keeps me in that frame of mind where I have to stay convicted to it, write that journal down, write that journal entry, make sure I refer to my plan if I execute something like that. But I don't think we want to allow short-term panic to cloud the vision of the longer-term trading strategy. But for that reason, I do like to use spreads because the point of me selling a put spread is to try to collect the premium. Now it's a trade. If I'm selling a put in order to try to buy the stock on a dip, that's an investment thesis. So keep in mind your trade thesis versus your investment thesis, your short-term trades versus your longer-term trades, and how you want to structure those as a result. Okay. Always be aware of earnings. We actually have a few tomorrow morning. The ones this afternoon don't look particularly interesting to me. But on a tear, I don't see a great earnings trade for it. There are a handful of others, Walmart, UW, Shake Shack. They could be somewhat interesting from an earnings structure. But the good news for a lot of these trading opportunities is that we've gotten past the big earnings for a lot of names. And now we can focus on the technicals for a couple of months until the next earnings cycle. So we get through some of the earnings. Depending upon your trading strategy, again, you can trade the earnings move for weekly options for this week, or trade the reaction afterwards, trade the follow-through, trade the continuation. Not revenge trading, but looking, or necessarily chase trading, but it's continuation trading and or finding those key support levels. I mentioned yesterday, and I'm going to look at it again today, Baidu. Baidu looks like it's starting to try to form some support. I am evaluating that for a potential bottom is in after a bearish earnings announcement. But if the technicals don't give me that sign that the bottom is, then I wait for that support to form and see if that opportunity arises tomorrow or Friday or next week. So constant evaluation on these, looking for signs of that bottoming process if I'm going to go anti-bearish, not looking for trying to catch the actual bottom of the move. Catching the bottom of the move is a dangerous trade with a lower expected value. Looking for the market to start to lift back up and find that support gives me a higher probability of success. It may reduce my return on capital slightly, but if I can increase my probability of success from 50% to 60 or 70%, I don't mind giving up a little bit of that return on capital and making 30% instead of 32%. All right. And that's where strike price selection also comes in for the anti-bearish trade in particular, as well as the bullish trade. So if I'm looking for a breakout and I think the market can rally 10%, I don't want to buy 20% out of the money calls, barring a true parabolic type scenario that could occur in something like, MicroStrategy or some of the other crypto related names or something AI. If I think something has a parabolic potential move, I have to choose a different strike than if I think it's going to drift higher or just not go down. All right. Long narrative this morning, but I wanted to get into it a little bit more in terms of trading philosophy in a choppy market, because right now the opportunities are more about the homework than the real big opportunities until the market gets some clarity. 10-year yield not going anywhere. Chop, chop, chop. I don't want to spend a ton of time on this, but it seems like our general range is now actually starting to set up as 4.4 to 4.65. We're at 4.56. Market comfortable with the 10-year yield, looking for that to move out of the range to maybe shift investment thesis. And then Bitcoin, I mentioned it with MSTR. And the potential for a parabolic move, well, if Bitcoin is finding a bottom here and starts to recover back above six figures, I look for explosive opportunity there. MSTR owns 250,000 Bitcoin. MARA owns 25,000 Bitcoin. Riot owns 10,000 Bitcoin. It's about a third of the market cap is their cryptocurrency holdings for those three stocks in particular. Hut's there on there as one of the bigger holders. Coinbase. You know, there are names that have great exposure to Bitcoin. If I'm looking to trade something that is related to Bitcoin without trading the IBIT ETF. Of course, if my true support level and my true thesis is built purely on crypto, I can just trade those. Much like I can trade gold miners when I see a gold move, I can trade crypto companies when I see a crypto move, or I can just go back to the pure whatever Bitcoin is. I don't want to call it a commodity. I guess just call it crypto. It's not necessarily a currency. It's a risk asset, right? It's a sign that tech growth is expected in general. It's a good proxy for that, and I want to keep evaluating in that sense. And then Bob put me onto this. You got a few months ago. I think it's been at this point. I do still like looking at MMFI as another barometer. A lot of stocks right by their 50-day moving average. So we're sitting at highs without everything being bullish. That, I think, is actually an interesting formation for the market. It means we're getting a little bit maybe over aggressive with some of the individual names. Traditionally, when we're starting to top out, it's a buy everything market. We're getting MMFI up around 70%. Right now, close to 50-50. So half the stocks are bearish, half are bullish. If you use the 50-day moving average as a barometer for that, i.e. above the 50 days bullish and below the 50 days bearish. So we're still in this range, looking for a little bit broader participation by the market to see bullish everywhere, but that can again signal more of a top than anything. So this is good. It's got good and bad to it. It means I can't go out and buy everything and make money, but it also means that the market's not a little over exuberant on the bull side. S&P's down about $1.25. It's a non-move day to start. We're within yesterday's range to start. Maybe the technicals allow us to drift to a high. Above yesterday's high starts to set up that continuation, confirming the breakout. If we start to drift back down, there's going to be some support around the 600 level. Below that, it seems like every $5. There's decent support at 595, bigger support at 590. More support at 585. Lot of dips that look buyable from support levels. Maybe some of them hold, maybe all of them hold and on a dip. And if one doesn't hold, I think people just start looking at the next $5 move. So given that, barring a fundamental input, there is a ton of support to this market on a dip, and people are structuring their trades, it seems, for that buy the dip mentality. SQDEX continues to stay a little bit elevated. People are buying protective puts throughout this process of generally keeping implied volatility near lows. Is implied volatility too high right now? I tend to think yes. This indicates to me that people are hedging by buying puts more so than selling calls. Maybe they already sold their calls. Maybe they're a little worried about that move to the new upside, so they don't want to sell the call. As we go through this process, we start to determine whether the upside move is going to be capped potentially by all the covered call positioning from institutions, or if that can actually create a launching pad as institutions have to flow back into the market once they're out by going through their covered call. Time will tell. I look for just potential scenarios as a result of what we're seeing in the VIX and the SQDEX. QQQ was sitting at the highs, made the new high yesterday, very similar to S&P's, very inflection point bullish, right? Semiconductors have been lagging in general, but seem to be starting to get a little bit more allocation. I think as people are looking for ways to allocate to tech, they are going back to semiconductors. We know NVIDIA is the big one, the biggest one. It looks very much like SMH. If people continue to go back into NVIDIA, that may create more excitement for semiconductors. It's a bit range bound. Had we not had the history of semiconductors moves over the last couple of years, I think this would be a bit more of a boring chart that people wouldn't necessarily consider as much as an exciting opportunity, but seems like we're getting to that point where maybe, just maybe, semiconductors can break out to a new high if the market's going to go to a new high, and then people are still going to look at it, even though right now the momentum's not there. Yeah, so let's see. Small caps continuing to underperform. This still, honestly, from a sort of fundamental bias, and I'm not a fundamental trader in general, but I expected some small caps to have a larger asset allocation and an investment thesis, given the current political situation. There was a big push towards small caps on the election, but really ever since the end of November, there's been a lack of love for small caps. Domestic names and everything else just don't seem to be in vogue. Again, maybe it's also partially driven by history. Small cap has not performed well relative to tech, AI, and semiconductors and crypto on a relative basis for years. And so maybe there's a hesitancy to get into that. But if that shifts, particularly with XLF trading near the highs, maybe we have a shift that can come. So got to keep that in mind. I do still like some of the big banks as well as some of the regionals. Regionals look a lot more like IWM, big banks leading here. If big banks break out, I could see a very realistic scenario, or it seems like a higher probability of success scenario where regional banks get asset flow. I'm in RF. I'm still holding it. It's chopping. I've got till March for this to break out to the upside. But right now it's just taking time and it's not there yet. So if it can get above yesterday's high, RF starts to look that much more attractive to me. As it stands, I have a small position there with March 25 calls. I'm looking to potentially add to that, or, maybe the better trade is still to focus on the ones that are working more now. Citigroup trading near the highs, holding near the highs, again, above yesterday's low. Seems to have no dip to it. Morgan Stanley getting close to a breakout, but pulling back a little bit today. If it can get above yesterday's high, again, that starts to look much more momentum focused with very little resistance. JP Morgan, been a superstar within the financials, and it's holding above, or actually just below, the breakout level of Friday's high. It pushed to a new high yesterday. But right now, there's just no pullback within the financial sector, and I can do this for almost any big bank and see either a breakout or nearing it. Bank of America being sort of an exclusion on that. Bank of America underperforming here, kind of a void to me when I see big banks rallying on the whole and Bank of America not really participating. I'd rather focus on the Goldmans, the JP Morgans, the Citigroups, the Morgan Stanleys. Heck, Wells Fargo, anything in this sort of range where it's close to the breakout or had already broken out yesterday or the day before. I'm looking to continue to grind out some potential return. All right. We may see a spike in something like we did in Citigroup on Friday. Maybe it's in Citigroup again. Maybe it's in Morgan Stanley this week. Maybe it's in something else. Continuing to evaluate some of those opportunities, but which one is a little bit tougher? I will say JP Morgan came up on the aggressive power trader list today. It looks pretty good to me. For execution on something like JP Morgan, implied volatility sitting at 19%. Downside looks to be towards 17%. Options are not particularly expensive here. Realized vol has been, though, around 17, 18%. Recently, midterm, closer to 16%. So keep that in mind that this is not necessarily about getting outsized moves every day, but more about getting a directional move and leveraging the delta of the option more so than the implied volatility of the option. It means I'm not going out buying March 300 calls. 300 calls are about that parabolic move. 280 calls, 270 calls are a little bit more about the probability move. 250 calls would be just stock replacement. Anti-bearish would be a shorter term for me. Traditionally, something like a 272.5, 275 call vertical or put credit spread. But this is one of those scenarios, like I mentioned before, where our return on capital isn't enough to justify the anti-bearish. I'm only collecting 30 cents on a $2.50 white spread. So if I do it via the calls, I pay 220 to make 30. It's about 15%, a little less than 15%. The risk doesn't justify the reward, even if the probability seems decent, because if we do get a liquidation, I don't know that 275 holds. 270 seems like a better level. There's no return on capital selling a 270 put or a put credit spread on the 270 line for JP Morgan. So I don't want to do anything there on a put credit spread. It's more about looking a little bit longer term for the continued trend up move. If I go that route, which I'm going to try to find something a little bit better so I don't lock up capital for 3 months buying JP Morgan right now for a trading portfolio. Investing, different philosophy. JCI also on the aggressive power trader list, very positive earnings, sitting near the highs, broke out yesterday. Again, looks very, very potentially strong here. I think it's more about that continuation though, with like a March near at the money, slightly in the money call. Micron. So for me, I don't want to do Micron. This looks rangy to me still, and maybe there's more here. Kind of rallying on the back of the Intel rally as well. But every time we get towards this 110 level, we seem to hit a brick wall. So until we get any sort of conviction above the 200-day moving average and really above, frankly, 114, Micron's not bullish. It's just choppy, and it's getting near the top of the range. Maybe the downside is only to 95. There's no put credit spread to say I'm going to stay above 95 or 96 with any real return on capital. I don't want to do anything with Micron. Finally, Nike, sort of similar to Micron in that we're bumping against resistance here. So if this can break out above the 100-day moving average, but frankly, really above 79, I get more excited about the upside continuation trade. A lot of resistance just above market. So for me, it's more of an avoid the trade. It's been bearish. It may be coming out of that. Yeah, I might be buying it at great value here, but I think that this could be a longer term play out than what I'm looking for. And so if I'm looking for trading opportunities rather than investing opportunities, I don't necessarily like going into Nike. All right. Tesla. Yeah, thanks, Ted. So Tesla, I actually really like here. It seems like we found that support level. We dipped below 340, and the conservative level is like 327.5. The weekly options for hold above 340 don't give any return, right? So I have to look for this via the more traditional bull outright with a price target of $400. Kind of get back into this range. The implied volatility is fairly low, but not as low as it can get. The realized volatility, even with this move downside, was only 54% relative to implied vol at 53%. Longer term, we're looking at like 47% for the last month or so, month and a half. So I don't want to just go out and pay a bunch of theta buying a bunch of calls. I like looking at Tesla for a call spread, 400. If I'm a little bit more on the bullish side, maybe 430. And getting a little bit of time, could be March. I could even go out to justify going out to April. I don't want to get into the next earnings cycle where we're going to have a vol premium for May. But if I see that recovery, I actually expect to see implied volatility start shifting back down below 50%. So, going into a March 370, 400 call spread or 375, 400 call spread makes some sense for that continuation recovery here. It looks like the bottom may be in and people are starting to get a little bit more excited about it. That's my general strategy there. With implied volatility high, I don't want to buy a long calendar where I'm buying March and selling shorter term. I'm thinking more along the lines of just a simple call debit vertical spread, a debit call vertical spread. So, that again, it goes like a 375, 400 for $7.50. Max value is 25. I could effectively triple my money if right. I probably wouldn't ever achieve the full max value of that call spread. I mean, if it explodes to 450, I'm still right, even though I was wrong, right? I was right to be bullish. I was wrong about the cap, but I get a little bit more of the premium because I have long delta. If we cap at 400, I'm structured right on with a 375, 400 call spread. And if we go to 450, I'd have been better off just buying like the 400 calls and getting a 5-to-1 payoff, going from $10 to $50. But that's not the trade that I see here. I think that there's some resistance above the market, and there is some leverage here with Tesla via some debit call spreads. Not the in-the-money debit call spreads, not the put credit spreads. Thinking the call debit spread with an upside bias for Tesla. Other names I've been highlighting, and I'm still evaluating here. Baidu, it broke yesterday's low. So now I look for the next support level. Maybe it's 88. Haven't gotten in yet. Waiting to find that support. Maybe it's 86.5. Because it's not clear yet, it's another day of waiting. We made a new low today. It's off the list for today. A bounce back towards 90, and I can get some good conviction on staying above 88. A bounce back intraday above yesterday's low. That could be enough conviction. But as it stands, Baidu, still not there yet. Still watching, still waiting. Love. Load. There we go. Above, 29.5 to 30 looked interesting. Right now, it looks like 29.5 is a better level because we are below 30. Again, still holding above this 200-day moving average. This is seeming to be key support. I could be on the aggressive side by getting in today. I'd like to see it move back above 30 before I start to consider really the anti-bearish trade, and it's for this week. A 29.5, 28.5 put credit spread should be about 20 cents. That's got a decent R&R. Paying 80 on the call vertical to sell it out at like 98. A little over 20%. Not bad for 48 hours or 3 trading periods, so a little bit more than 48 hours. But at the end of the day, if Love can find support, that could be interesting. UAL, a bit more bullish within the jets sector, the airline sector. 102 had been my level that I was watching closely here. We had this break on February 13th that is concerning, puts a little bit of risk on it. If I want to be a little more conservative, staying above 100 with the 9,800 put credit spread is 25 cents, but that's only about 15%. I need to get the conviction for me to stay above 102, collect that, right now it's 65 cents. If it gets down towards 50 cents with the prices up closer to 104 and change, I've got some better conviction there to get that, again, 25-ish% return over 2 days. So maybe a late day trade today would be looking at the UAL Feb 100, 102 put credit spread. See how the market handles this dip. See how UAL handles the 50-day moving average. See how UAL handles the retest of this 101.5 range. Today's low is 102.37. If the lows are in for the day, maybe I can get some confidence that the lows are in for the week. And Delta, a little bit weak on a relative basis, so I'm avoiding that after having used that as a good support level at 64 for a couple of weeks. Now, to me, Delta is a non-trade situation given current market conditions. WMB moving a little bit more this morning. This looks like it may be starting to set up that bull run again, back into the 60s range. March 60s or a little bit longer, maybe into the April 60s, still looks attractive. There should be a ceiling for April at the 65 strike, 15,500 open contracts. I think this looks like a big risk reversal to me. Market short the call, the investment community long the stock, short the call, long the put, big risk reversal. Looks like there's some buyers on the March 60 calls today. They paid 120 and then we kept going. There's big open interest in the March 60s that could create an initial magnet target. The February open interest is pretty lean. So my big focal point on the open interest is the March 60s and then the April 65s. And then maybe the March 65s. Let's see how this plays out. But it looks like WMB with their positive earnings last week is really setting up a bull run here and could be that much more interesting as a result. When these names start to go, they do often get a little, these energy power companies start to go. They could be that much more exciting. And WMB is the initial leader because of the positive earnings. If it continues, One Oak should start to participate a little bit more as well. Maybe the KMI could be interesting on the pipelines. These are all forming some interesting bottoming formations and starting to set up again potentially for kind of a bottom and then run. down and then run, down and then run. This was all off of DeepSeek. If that news is behind us and we're disregarding it, Eaton Power Company, maybe another one that's, a lot got hit really hard on January 27th, trading near the lows. And again, could be part of that trade philosophy, sort of more of the at the money call March or April though. Okay. Yeah, let's take a look at those, Carmen. We got ALLE, Allegion. This looks vulnerable to the downside. Poor earnings, now breaking below the lows from January 13th. I want to know if this support level is going to hold. Implied volatility is not cheap, not high. Kind of check are the securities or security range. Bug has been getting a bunch of money on the cybersecurity side, but down a little bit today in ALLE. So if that's forming a top, that actually might put a little bit more pressure on ALLE. The options are not very, it's very difficult to trade the options in this one, given the width of the markets. For the bull, I think we need to see prices back above yesterday's low to try to form that support level, but the support here is very weak. There's not a lot of levels below this current price that really form support, maybe down into the 115 range for the lows back in June of 24. But on the short term, the bear is certainly in control here. I think it's a waiting game for the bull. For the bear, it's a limited downside. Just, I would use a stop out as yesterday's low, looking for that continuation downside, and then kind of a trailing stop philosophy if it continues to break. And if we get down towards 115, 116, then kind of looks like it hits the price target on the bear's viewpoint. EBAI. So we're looking for a sign of this drawdown setting up the next move up. We've had a nice run above yesterday's low, starts to maybe set up the bull trade. Until then, I don't normally try to get too aggressive with playing the bear side. I mean, $5 could be a target for the bear, but the bear, big bear. But I think the interesting trade is back above yesterday's low, back above the 10-day moving average for a potential leg to a new high. And right now, I'm just thinking wait and watch here. It's showing some vulnerability. It's doing so on limited volume. So a lot of buyers over the last couple of weeks. We haven't had capitulation selling yet, pitching out the trade. But the buyers need to resurrect in order to get that next leg higher. Say for maybe the AI trade, although it's, towing support here. I wonder if the options are okay for an anti-bearish. No, not enough premium. 30.5, 29.5 put credit spreads about 15 cents, close to 20%. To stay above 30.5. That would be in line with the January 14th and January 27th low. We did dip below it, but rejected that low on February 3rd. So for C3 AI, that might be an easier way to make money for the next couple of days than getting into the more wild move of BBAI. If we hold this 100-day moving average, hold here around 31.5, I think AI 29.5, 30.5 credit spread looks more attractive as a short-term trade. 48-hour trade, and then move back to the momentum type trades after that shows that it held. That's the higher probability of success. BBAI is a little bit more of a day trading type trade for now, looking for that move above yesterday's low to show that there is some buyers here. It could be a bull flag, Carmen, but it's not there yet. So we need to get for a real day's high than anything, but you can see the short term downside. I need to get above that line. So I guess it's like 880 today. Better trade for me on a bull flag is tomorrow, getting above about today's high. It's a steep draw, a steep flag, but it could set up with a move above 8.5 tomorrow for that test of 10 and change. But right now the buyers aren't there. So no bull flag yet, maybe starting to set one up. All right. We do have, I don't love the fact that, these higher lows has been somewhat interrupted here during this. We have the steepness of the higher lows. It is higher lows, but it's not as steep, and it starts to show a little bit of waning interest by the bull, slowly trying to figure out where that aggressive buyer starts to come back in. Is it today's low, and then we set up a wedge here? But what is clear is that this steepness is gone. And then it's trying to find that new support level, that new buyer level for BBAI. And it's not found its support level yet for me to want to buy into it. So wait and see, or at the very least, if long already, maybe just use today's stop as or today's low as a stop out, and then look for a new potential entry because the buyer just isn't there today. So if I'm trading short term, I got to use short term exits as well as entries, and evaluate new potential opportunities as I'm going through that. I should note here, oil firm today again, testing the resistance area here that was forming from the end of January and some of February here. That is interesting for the XLE side. We're seeing a 1% rally in XLE, showing some bullish chops here. ExxonMobil could be an interesting play. It's not broken out above the range for 2025 yet. CDX has been a little bit more bullish over the medium term, but like MPC seems to be my leader there. Back above 159, basically up on the day, makes MPC look pretty attractive to me. There could be some resistance initially, but above 159 starts to look interesting. Again, I think this is more of looking out at like March calls or call spreads to target a move back maybe as high as like 170 to 175 range. The premium for the 170, 175 range is enough to sell, at $1.70 or $1 on the 170s and 175 calls. If we get a parabolic move in all of oil, it may not be best suited for MPC. Maybe it goes back to, a Schlumberger for a potential move above the 44 range, or Warren Buffett's favorite, Occidental. It's already gone about 5% today. So their earnings actually look like they had an impact on them today. Yep. What did Devon do with their earnings? 9%. These are big moves for the energy names on earnings. We normally don't see this magnitude of a move. Devon Energy, normally about a 3% type move. Today, getting almost 9%. Oxy's earnings, 5%. One of the bigger moves of the last 2 years. That bodes well for the XLE or OIH trade potentially here. OIH actually lagging a little bit. I think energies are starting to become more interesting. They could be like the financials where they're in the early stages of it. Financials becoming more and more interesting now that they're at the highs. XLE a little bit earlier on in that potential asset allocation. They've been a widely disregarded and ignored sector, kind of the IWM style situation. But if they start to become part of the asset allocation, people want to move back into energies. I want to be ready to jump on a couple of them. And I think ExxonMobil, even though it's been lagging, it's one of the first that people look at, that people look to allocate to. And that's what makes it particularly intriguing to me. Kind of like saying, if I'm looking for semiconductors, I pull up NVIDIA first. If I'm looking for XLE, I pull up ExxonMobil first. All right, so that's my energy view there. Let's do those earnings for tomorrow morning because I don't want to miss out on them. I mentioned Baba. I'm just going to pull it up So you can see why I have absolutely no clue what to do for earnings here. I don't want to make an earnings play. It's at these ridiculous highs after a parabolic move to the upside. I don't know if it's going to have a standard earnings move of 5%. That seems unlikely to me given the way that we've moved. 10%, maybe in the cards. Maybe we move 5%. But we were getting like 5% moves just off of individual days. 5% is only $6. Puts us back to the highs of, 4 days ago, Wednesday, Thursday. To the upside, maybe it gets explosive. If we move 10%, we're down towards 13, kind of in no man's land here. I don't see a good technical setup in Alibaba. I don't know how big the earnings move can be given the random walk. Well, it's not random walk, the somewhat parabolic move here on the upside. I don't want to do anything with Alibaba. Walmart, though, could be a little bit more interesting. So Walmart is also sitting at highs, has had a bit of a trend. Normal earnings move here, though, is about 4%. We've had 7%, 8% type moves. 4% is kind of the norm. 4% would be right down back to $100 a share. Big round even number, maybe some support there. The symmetrical move here is about 100 or 104. 108. 110 looks like a bigger number. If we end up with a bullish day, settle in around 105, that would be best case scenario for me. We do have pretty spread open interest on the put side because we've had this run. So people have been playing with many different put strikes, but 105 or 110, on the upside seems like a magnet level. So I'm thinking about this as in terms of using 110, and then to be symmetrical right now, it would be 98. I'm more inclined to use 100 just because I think these round numbers matter a lot to the market, and they traditionally build up a lot of open interest. March hundreds haven't built up a ton of open interest though. April hundreds haven't built up a ton of open interest though. 110 has built up a ton of open interest in April. And in February, it's a pretty concentrated number. 100 does have a lot of open interest on the call side. We may be in a situation where people are long a lot of calls for Walmart, and that may not actually create the magnet effect if that's the case. A questionable maybe trade with 100 and 110 looking like decent open interest and right within the normal realm or range of movement, though. Unity, normally about an 8% move, maybe 10%. Right now it's pricing in 12%. 10% down puts us down to 19, right here at the low from last week. To the upside, 23 and a half, right at the highs of January and late January here. Those look like pretty good technical levels. So, there's no open interest, but the technicals look intriguing. So it's a trade-off here where I have to say the options aren't perfect, but the technicals maybe. 19 has some open interest, but there's pretty spread open interest on both the call and the put side until I get to 25 on the upside or down to 17 on the downside. I think 17 is more likely irrelevant. They are, dime options, but thinking about 19 and 23 and a half as potential targets there. Again, if I was going to grade it on the letter scale, it's like a B. It's not an A plus trade. It seems like a B. The better trade to me right now, honestly, looks like Wayfair, although the 5% drawdown now today may be shifting that somewhat. Normally 13% move, 13% in Wayfair is about $6. That would be 40 now. If I added back the $2.50 from today, that would have been 42.5 and looked pretty positive with a 42.5. 52.5 didn't look like anything too major. It was really that 42.5 level that was exciting me, but now with a $2.50 drop today, I may be less inclined here. If this gets back towards unchanged, I like this for the earnings play with 42 support. 42.5, big or decent open interest. 50 55 on the call side has good open interest. I liked this a lot better, honestly, from coming from 49, $6.5, $6.5, $6-ish down to 42.5, $6 up, going to 55. I want to see how this plays out during the day, maybe a late day trade if it recovers. If it doesn't recover, then we're back into no man's land on it, and 42.5 isn't the number. Maybe I'm looking at 40. But that's open interest built rather than technical built. So it's an A trade if we're coming from 48, 49 range. It's a B trade coming from 46.5. How's that? Now you got to watch it all day, see how it goes. Shake Shack, another one that could be somewhat interesting here. We did have a nice rally yesterday, but pulled back. And their earnings normally are about 8%. We do have a big dispersion here, though, 8% up to 26%. If I get a normal 8%, it's after the $4 drop, no longer looking at 105, looking more down to 103, which, again, kind of in no man's land. So the morning selling here in these names may be shifting the opportunity away from these earnings opportunities. But into the afternoon, keep an eye on them. If we recover back towards unchanged in Shake Shack and Wayfair, they start to look really interesting for using some of these prior lows as support levels for the trade. Shake Shack doesn't have a ton of open interest, so it's not a very liquid options trade. Maybe more like GoDaddy that I looked at before, where I can't get in because the options market's just not very liquid. GoDaddy, I was looking for it to potentially hold a minor break, and it ended up collapsing. So thank you for the market not being liquid enough to get in. But, that's the benefit sometimes of illiquid markets, is if the options are illiquid, it can sometimes be a precursor for a bigger move in the stock when earnings come out much more bullish or much more bearish than the market was expecting. The liquidity aspect of it, if people have to get out of GoDaddy after piling into the position back in November, seems like the bull is very vulnerable there now. All right. Yesterday's earnings that we had, we can take a look at them and just see if they're forming any support levels. ANET down 8%. Normal move in ANET has been around 10%, so it's pretty in line. Little bit smaller move than norm, but pretty right in line here now at 102. We were looking at it yesterday, thinking about potentially a move down into the 97.5 range on the bear side. Now I'm inclined to think that 100 may provide some good magnet effect. Looking at a butterfly, the 102.5, 197.5 after the earnings are out, that's about 50 cents right now, looks somewhat attractive. Again, just thinking that there's no reason for it to just turn around on a dime right now. Stargate was bullish, DeepSeek was bearish. It's taken the bearish side of things and going that direction right now after the earnings announcement, and maybe looking for 100 pin here over the next 48 hours. And I don't have to rush into that. I can watch some of the trade throughout the day and see if that 100 level looks like it's going to be the magnet. If we start to bounce back towards 103 or 104 today, that negates that thesis. But if we hang in this range, then the drift down towards 100 seems like a natural target point. CDNS, big move today, down 10%. Its normal move is like 3%. So we had the bigger move, much like we had in October. After the October bull run, we had a little bit of a chop before the next move. I think I just hold off here in CDNS. Etsy, bearish. So my personal bias was actually the dead on trade here. We went right down to support levels 52. The earnings normal move is about what we got here. So we got the normal move to the downside. Much like Pinterest, I avoided trading it because I know I have a personal bias. Absent my personal bias, we were looking at, down to 52 or potentially up to 62. But 52 seems like it could be an interesting target zone here, maybe down to 51 with a bigger open interest. Again, I think this is more of now a potential for a call credit spread, like a 54-55 call credit spread. What gets that seated back above the 100-day moving average and all of this trade that happened here? So not bearish in that sense. It's the anti-bullish scenario. But again, because I kind of have a personal dislike of Etsy, I just don't see the point of it. I know my technicals can be somewhat biased by or impacted by my underlying bias. So psychologically, I kind of try to avoid those names and just trade the stocks that I think that the market may have a bias towards, but I don't. Like, I don't love NVIDIA, but the market loves NVIDIA. I don't love or hate NVIDIA. I don't love or hate Micron. I don't love or hate United Airlines. I like the stocks that I have no real fundamental viewpoint on. And even though I try to disregard my fundamental viewpoint, I know it's there underlying. So kind of going back to trading psychology in that regard of avoiding stuff if I think that I might have an underlying bias and be looking for a trade that may not really be there. That said, I think the 54-55 call credit spread is there in Etsy, playing for the anti-bullish. That could be negated today if we start to move back and bounce back on earnings towards today's open. But as it currently stands, I'm not sure that there's anything that's going to get people excited to go turn around and just hit the buy button for Etsy. I mean, heck, even Pinterest, it was bullish on earnings, but nobody's really hitting the buy button. We're starting to form some support at 38.5 for the bull. The 37.5, 38.5 put credit spread, I think, is a logical thesis for a couple of days, but I can't convince myself to be long Pinterest, so I won't trade it. All right. But if you are bullish in Pinterest, if you like it, as long as we stay above the lows post earnings, it still looks pretty good. But for the bull, I don't think it's there yet. It may need a couple more days before it can show that bull flag setup with a retest of 41. So more anti-bearish than bullish, and then above yesterday's high can start to look for a little bit more bullish trade, a little bit more leveraged side of things. All right, what else do I have on my? Oh, I mentioned IBIT, and I got to go back to that. So IBIT coming back towards yesterday's highs. And so immediately I want to pull up MSTR unchanged. It's not a leveraged upside move yet, but if IBIT, let's just use Bitcoin prices. If Bitcoin goes above or starts pressing back towards $100,000 for Bitcoin, leverage in MSTR is very cheap right now because it hasn't been moving as much. So the realized volatility you can see is very low. That doesn't mean that the future volatility is going to remain low. If Bitcoin gets bullish, I expect MSTR to get more volatile to the upside. So looking for potential outright long calls in MSTR for a big play, it's going to mean a larger portfolio to go out and buy 350 calls. They're $2,000. That's more of the type of play I like in MSTR when it lines up. That makes more sense. If that's too expensive, I go back to MARA. They do have earnings next week, so I don't necessarily have a huge opportunity from that regard. I can't necessarily play this out without accepting the fact that their earnings may derail the trade and is pricing in increased volatility. Same idea with Riot. So keep going down the list. Maybe HUT. HUT has a couple of weeks to play out before their earnings come out. BTDR, they're next week as well. Yeah, it looks like most of the crypto names have their earnings next week. Blah. MSTR is the only one that already has earnings behind them. Well, I mean, I think that for me, that means that MSTR might have to be more of the play. If the capital constraints are the issue, then got to go for a call spread. As much as I hate reducing the potential upside, but a 350, 400 call spread, now I'm down to $1,000 or $1,100 for the trade. It's much more reasonable. or just going back to IBIT. And then post earnings for the others, when their implied volatility falls, can look for something a little bit more aggressive. But if IBIT gets above this level around 57, 61.5 looks like a natural resistance point, like March 57 calls, those still double, and I can still have some leverage to the upside if it continues. I don't necessarily like going out and selling, again, the call side of anything crypto related, because when it gets moving, it has that potential for that parabolic type move, and I don't want to cap my potential return. So if I shift my thesis and we find resistance at 61.5, I can just exit the call, walk away, trade again another day. I could then turn it into a call spread, call vertical spread, wait for some consolidation. Or I can replace my in the money call with an out of the money call for the leveraged upside move if we get the continuation on the parabolic. I like having the optionality of just a long outright call with IBIT, particularly as we see the implied volatility here. And they don't have as long of a history, so we'll just pull it up with BITO. You can see implied volatility in crypto is at 6-month lows as well. So with implied volatility on the low side, if that momentum and if that excitement for crypto starts to return to the market, I prefer a long outright call slightly out of the money rather than a call vertical. And that's a little bit cheaper execution, well, significantly cheaper execution than going into MSTR if you're in the crypto bull crew. All right. And going back to the dollar alternatives, gold just sitting right now. Silver pulling back a little bit. Could be an opportunity as FXI has been showing some bullish chops and has been outperforming silver. Gold has been outperforming silver. Gold miners have been outperforming silver. If we are really going to shift more into precious metals and keep gold high, I still think silver has some catch up to do. I still like silver. Maybe if gold pulls back, that actually creates a buying opportunity in silver on a dip. As long as some of these support levels hold around 266. And this is a spot where a pair trade could make some sense, buying some silver and short-term hedging with gold. So having some exposure for the silver move. The gold downside is a lower probability element, but it is there in case we repeat the February 14th move. That can offset some loss if we get a precious metals, a rotation out of precious metals. All right. So there's kind of a lot here, but I think for me, still my focus is going to be continuing to try to find some good put credit spreads, if any, today, continuing to look for those opportunities. I'm thinking AI might be the best option there, given this sort of lack of any real movement and the support that exists right below the market. That 29.5, 30.5 put credit spread for this week gives a good enough return on capital to go that route. If I can get around 18 to 20 cents, right now it's about 18. I don't think I'd want to sell it any lower than that because I want to still have around 20% return on capital. Otherwise, Baidu's not there yet. Love is a question mark. United Airlines, again, could be an interesting one. And I didn't look at Starbucks yet for the potential breakout. It's not breaking out today, but it is very close. So this is teetering on the edge of a next leg higher, ascending triangle here. We've got a hard line stop here, or breakout level of the highs. And you can see the ascending triangle since earnings. If I even just skip the earnings date open, we're getting into an inflection point here where Starbucks seems like it's a coiled, ready to go move. If it starts to break, the MACD crosses and I start looking down to 105. But if it can push through, which is the normal setup that I'm looking for in an ascending triangle, is the breakout, not the breakdown. If it breaks out, long outright calls make a lot of sense with implied volatility at lows. Looking at like March 115 calls. A little bit out of the money, not terribly out of the money. still have some probability if it's less slower move. Not necessarily looking for Starbucks to get parabolic, but it wouldn't surprise me if it did. I mean, heck, if AT&T can start to look more like a parabolic move to the upside, why can't Starbucks, right? If T-Mobile can have parabolic type moves to the upside, why can't Starbucks? So the market is what the market is, and Starbucks looks like an opportunity in that's very close to a potential really good move here. So, yeah, to summarize again, AI put credit spread potential, United Airlines put credit spread potential, Starbucks breakout potential. And then for the aggressive power trader type system, JP Morgan, JCI looked like the two best ones for me for today. But I kind of like some of the other stuff that I've been finding independent of the AI just for what I'm looking for. So I think I'm going to focus on those. Oh, and Win did look interesting here as long as it stays above that 100-day moving average. That was yesterday's aggressive power trader name that, along with Morgan Stanley, that look potentially interesting here. Okay. Any other last ones here before I let you guys go? Vlad will be on for the close. I'll be on for the close tomorrow. Best of luck today. Keep an eye on, if you like the earnings trades, keep an eye on Wayfair. If it bounces back towards unchanged, I think that one gets very exciting from the normal realized moves and the support and resistance levels. But it requires watching through the day to see if those are going to set up. All right. Thanks, everybody. Have a wonderful trading day. Stay warm. And I'll chat with you guys tomorrow. And Vlad will chat with you guys this afternoon. Thanks again. Robert, I'm Keith. Yeah, Keith Harwood. And Vlad and I partnered up for the paid program, and we're doing a lot of other new projects that we're working on together here. So yeah, I'm always on for, or the normal, I'm on for the close Tuesday, Thursday, Friday in the morning on Wednesday. So looking forward to chatting with you more if you can make the closing bell tomorrow or Friday. Love to have you on. We can chat more about what we're seeing going into the end of the week. Thanks again. Oh yeah, Robert, Vlad's great. He's we're just kind of dividing up a little bit to get a couple of perspectives on the market. So he's all good. He'll be on this afternoon. Thanks again.